Assalamualaikum warahmatullahi ta'ala wabarakatuh, and hello to all of you. This is Dr. Aisha. Today we are going to learn about Chapter 6, Capital Budgeting and Cost Analysis. And this is the topic. If you look at the textbook, it is in the chapter of 21. Okay, it is in the 21st chapter. Alright, so today we are going to look at the content for this chapter, and we are going to look at the question, long question related to this topic. Okay, capital budgeting is actually the process of making long-run planning decision for investment in the projects. You already learned before about the short-term decision making, relevant information. And in the case of, for example, company have to decide whether they want to take special order, whether they want to add customers, whether they want to restructure their products mix, etc., etc. That is basically related to short-term decision making. But once we talk about capital budgeting, it is actually referring to the long-term decision making, where it is normally takes obviously more than 1 year. Okay, so in choosing this investment, managers make a selection from multiple projects, and each of which may span for several years. So business sometimes they have several projects that they plan to do in future, so they have to consider this factor, which investment that possibly will bring the highest return, or which investment actually will bring negative return. So this kind of decision, they really need to have a proper analysis of the cash inflow and cash outflow of each of the projects that they want to engage in the future. Okay, to make a capital budget decision, managers will analyze each project by considering all the lifespan cash flow from its initial investment through its termination. So it is from the beginning of the project till the end of the project. During the termination, still there is a process of cash inflow or cash outflow that will occur. So this is something that managers have to consider. In the textbooks, there are 5 stages to the capital budgeting process. Alright, so stage 1 is about identify the projects. Okay, in the sense that managers have to identify potential capital investment that agree with the organization strategy, that is in line with the strategy that has been released by the company. Stage 2 is about obtain that information, gather information from all parts of the value chain to evaluate alternative projects. Stage 3 is about making prediction, because it is important for us to predict about the all potential cash flows attributable to the specific projects. Okay, so this prediction is important since the company might engage in this project for several years. So in order for us to get a grasp of understanding how much actually we can get of the cash inflow, or how much of the cash outflow that will occur, so all of these things will be a part of the consideration. Stage 4 will make decision by choosing among alternative. For example, determine investment yield of the greatest benefit, which project is actually can get a positive net present value. Okay, so what about the payback? So this is the decision that they need to do by the managers. And stage 5 is about to implement the decision, evaluate performance, and learn about the project itself. Okay, in regards to stage 5, that is implement the decision, evaluate performance, and learn. This is actually will lead to 2 main action. That is the first one, they have to think, manager have to think about how to obtain funding and make the investment selected in stage 4. Okay, and the second steps that they have to take is to track realized cash flow and compare against estimated numbers and revise plan if it is necessary to do so. Alright, in this topic, there are 4 capital budgeting methods to analyze the financial information. This is something that you already heard when you are doing in finance, for example, in the finance topic, in the finance course, then I expect that you already learned about this. The first one is Npv, IRR, payback, and the fourth one is accrual accounting rate of return. Okay, but in this topic we will just cover for Npv, IRR, and payback period, because actually it is sufficient. If you look at the Npv is positive, and the payback is good, normally we can consider that the project is accepted based on that evaluation, right? Other important things I have to highlight to you is that both Npv and IRR, internal rate of return, they use discounted cash flow. And now have a look at what does it mean by discounted cash flow? Discounted cash flow methods measures all expected future cash inflows and outflows of a project discounted back to the present point in time. So all of the expected future cash flow, we will bring it back today. So I will show you the example on how this discounted cash flow work in the question later on. This discounted cash flow is actually focused on the concept of time value of money, okay, that you learn in finance, similar, where a dollar received today is worth more than dollar received at any future time. Okay, so the money you receive today, whatever the value it is, in terms of value, it is higher compared to the similar dollar that you receive in future. All right, that's why, possibly your parents, for example, told you during their school time, if they, for example, just bring 50 cents, it is enough for them to buy food and drink. But as for today, it's no longer, if you bring, 50 cents to the canteen at the school, I'm not sure, because I don't think you can get drink. Possibly just one piece of kueh, for example. So using the similar amount, that is 50 cents, but in terms of value, in the past, so many things that you can get with that similar value compared to nowadays. So this is how you should internalize the concept of time value of money, where for example, ringgit today is not similar to the ringgit, for example, for the next 10 years or next year or next 1 year. So the value will be reduced in future, basically. Alright, so both Npv and IRR, they apply discounted cash flow method, and it use required rate of return. Okay, that is, required rate of return means the minimum acceptable annual rate of return on investment. Right, this normally has been set by the company. Okay, the required rate of return on the investment. And the RRR, also sometimes they call it as discount rate or hurdle rate or cost of capital or opportunity cost of capital. So they are actually referring to the same thing, that is required rate of return. So if, for example, in the questions they didn't tell you that they give you the specific RRR, but they tell you that there's information about cost of capital, so it means that cost of capital information given is similar to the required rate of return. Okay, now we look at a bit about the concept for Npv and IRR. The Npv method calculates the expected monetary gains or loss from a project by discounting all expected future cash inflows and outflows back to the present point in time using the required rate of return. Okay, so all of the cash inflows and outflows in the future, it will be bring back to the present time. So that actually the main concept in Npv. In Npv, for example, once you calculate the Npv, once the Npv show positive value, it means that the project is acceptable or profitable. So that's basically the general rule of thumb in net present value. The internal rate of return, the IRR method calculates the discount rate, okay, at which an investment present value of all expected cash inflows equal, all right, similar to the present value of its expected cash outflows. So cash inflow and cash outflow is similar at the specific discount rate, that is the rate of IRR. So in IRR, right, beside of it must be similar between the present value of all expected cash inflow and cash outflow. When you reach IRR, okay, the NPV will be 0. Okay, so this is basically the concept behind the IRR. Okay, and the next one is about payback method. So the payback method measures the time it will take to recoup in the form of expected future cash flows the net initial investment in a project. The payback method does not distinguish the sources of the cash flows, such as those from operation, purchase or sale of equipment, or investment or recovery of working capital. So payback method normally referring to how many years it takes for the projects to start to gain a profit. So this is the formula for payback method. It's quite simple basically, and it can, the cash flows in payback method can, for example, it can happen in two situations. Number one is uniform cash flow. For example, let's say 100,000 per year for 5 years. So first year is 100,000, second year is 100,000, third year is also 100,000. So this is consistent, uniform. However, in the ununiform cash flows, where the cash flow might be different, it's different, between 1 year and second year and third year is not similar. So the calculation will be a little bit or slightly different. Okay, and this has been clearly explained, the example in the textbook. Alright, in the past you already learned about relevant information. So similar to the concept, now at this topic we also will learn about relevant cash flows in discounted cash flow analysis. So one of the biggest challenges in capital budgeting, particularly related to discounted cash flow, is determining which flows are relevant in making an investment decision. So in this instance, it is important to identify the expected future cash flow and the differences in expected future cash flow. In this subtopic, another things that you have to understand is about the relevant after-tax flow, okay, where it will use the concept of differential cost and differential revenue, and we will also consider the taxation in that particular phase. Okay, we use the concept of differential cost and differential revenue, and we will also take into consideration the taxation that the company have to pay. The second part is about the categories of cash flow. You have to understand several types of cash flow category. Number one is the net initial investment. Net initial investment, it includes the acquisitions of the asset, any associated addition to working capital. It will minus the after-tax cash flow from the disposal of existing assets. Okay, and then after that you also have to learn about the after-tax cash flow from operation, which includes income tax cash saving from annual depreciation deduction each year, and some cash flow it come from the disposing of the assets or the termination of the project. So once the project is terminated, then some cash inflow occur. All right, so once we terminate the project, certain things, like for example, we can recoup back our working capital, we can sell our assets, so it can create cash inflow to the company. So these are, like the different types of category of the cash flows which happen in the company. Number one, once we want to start the project, obviously, of course, we need a initial investment. Okay, that is one form of cash flow. Number two, during the operation, all right, so of course we receive income from operation, so it's also a part of the cash flow. Number three is once we terminate the investment or the project, so we can sell some of the asset, so it will also create a cash flow for the company. Okay, now we look at the question. Okay, long question for this topic. JDR Berhad is currently using a manual painting machine which was bought 5 years ago. Today, there are some sophisticated models of these machines available in the market. Okay, so that is the current painting machine that the company already currently use. But after certain years, because it was bought 5 years ago, so now some sophisticated model are available in the market. So JDR Berhad is considering the following possibilities: whether they want to replace the manual machine with an automated machine, or they want to just continue with the current machine that they have. Alright, so now we look at the information given. The current cost for the more efficient model being considered is 900,000 and will require an additional 30,000 for transportation and 20,000 for installation costs, right? So this is the information in regards to the new machine. Okay, so the cost is 900,000 with the additional 30,000 for transportation, 20,000 for installation. It is expected useful life is 5 years and it could be scrapped at 200,000. So once it reached the useful life, okay, we can sell it for the price of 300,000. The firm uses straight line method to depreciate its assets. The present machine, okay, so this is the second paragraph talking about the present machine or the current machine that they use, which originally cost 250,000, okay, can be sold today for 90,000. All right, so this is the cost at the disposal. This machine is being depreciated on a straight line basis over its useful life for 10 years with zero salvage value. So useful life is 10 years, you remember here, and this machine was bought 5 years ago, means they already used it for 5 years at this point of time, and they still have a remaining useful life another 5 years at this point of time. Okay, if replacement takes place, it would increase output. Okay, so once if they replace to the new machine, the output will be increased, which means sales would increase by 272,000 per year for the first 2 years, by 290,000 for the third year, and by 300,000 per year for the remaining years. In order to compensate the increased sales, the firm would have to increase its investment in working capital by 55,000. So in order to cope with the increase in sale, company have to make an investment on the working capital for another 55,000. Since the machine is fully automated, it will reduce labor costs and cost of defects by 40,000 per year and 15,000 per year respectively. The firm's fixed cost is 35,000. The company corporate tax is 26% and the cost of capital is 12%. So this is actually the required rate of return. Okay, this cost of capital is actually the required rate of return. Alright, so what you need to do next is to compute the initial outlay, compute the differential cash flows, compute terminal cash flows, the payback period, compute the net present value, and you need to complete with A, B, C, only then you'll be able to calculate for payback and the NPV. Okay, F is using the payback period, and the desired payback is 4 years, and the NPV, you need to make a decision whether the machine should be replaced and give reason. And G, explain why in order to make a long-term decision, the organization need to take into consideration the effects of the inflation and taxation in capital investment appraisal. Alright, now we look at the solution for this question. First, we have to calculate the initial outlay. So, initial outlay basically related to the cost of the asset and whatever cost that need to occur in order to make sure that the asset that we bought can run smoothly in operation. So, this is basically the cost that we need to consider, the purchase of the new machine. Alright, this cost 900,000 is given in the question. Alright, this is the cost of the machine, okay, that we want to buy, that the company want to buy. So beside of that, we also have to consider the transportation cost. This is considered also a part of the cost. Alright, so this is also the a part of the cost of inventory, because without the transportation and without the installation, the product cannot be used. Okay, the product, the machine that we buy, it cannot run in the operation as normal. So that's why still beside of the cost of the product, another cost, that is transportation and installation, also need to be considered as a part of the cost of the product, because without all of this cost, the product cannot run in operation. Alright, so this cost, the transportation and installation given to you, and you can get here the depreciable cost. This is the cost of the asset. The real cost of the asset is actually 950,000. Okay, so in this initial outlay, beside of all of these costs, we also have to consider, because the point is like this: if we already have the asset and we want to make sure that it reach the capacity that we want to produce, as in the question given, alright, in order to cope with this new production system, the company have to increase its investment in working capital. So you need that to support this machine operation or production of this machine. So we need, that's why we add with the working capital requirement, and this is the total cost, this is the total initial outlay that occurred or that need to be paid by the company, that is 1,005,000. Okay, so the first part of the initial outlay, alright, is related to the cash outflow that occurred by the firms. And in this initial phase, because we buy the new machine, so we have to sell the old machine. So it seems that there will be a cash inflow that will be occur in the company. The cash inflow comes from proceed from the sale of the old machine. So once we sell the machine, alright, as is has been given to in the questions, that the current machine, if we buy the new machine, we still can sell it for 90,000. So the proceed from the sale of old machine is 90,000, and we can get also the tax gain here, alright, of 9100, and we have to calculate for this 9100. I show you the calculation. Okay, the sales of the old machine is 90,000, but at the same time we also have to calculate the book value. Only then we know whether we are making loss or we are making gain out of the disposal. Okay, so we have to understand here how we can calculate the book value. We look at the cost of this machine, that is 250,000. Okay, this 250,000 is the cost of the machine, right? It's given in the question here. All right, so at the end of the day, Okay, if we use for 10 years, the salvage value is 0. So 250,000 of the cost minus the salvage value, divide with the 10 years of the useful life. Okay, so it means that actually the depreciation for each year is this 25,000. Okay, so the cost is 250,000. Alright, and the depreciation per year is 25,000, and it has been used for 5 years. Means that the accumulated depreciation is 125,000. Okay, so the remaining will be the book value. So the book value, that is another 25,000 times with 5 years, because this is already been used. This is not used yet, so this is become the book value of the machine. 25,000 times with 5 years, we can get here, alright, 125,000. So the book value is 125,000. That is 25,000 times with 5 years, another 5 years remaining of the useful life. So out of this 250,000, half gone for the accumulated depreciation, and half will be still remaining the book value of the machine. Alright, so sales, this is the book value actually, 125,000, but we only managed to sell it for 90,000. Means that we make loss out of the disposal, because the book value is supposed, is higher than the sales value. So that's why we make loss. So once we make a loss on the disposal, we can get a tax gain times with 0.26 is actually the tax rate given to you. Alright, so the tax rate is 26 or 0.26 here. Then we can get here 9100 of the tax gain from the loss of the disposal. Okay, so as for here, alright, this is the proceed from sale of the old machine plus with the tax gain that we can get from the loss of the disposal. So we can get here the total is 905,900 cash inflows. Alright, next we have to calculate differential cash flows. But before we calculate differential cash flows, we also have to calculate the differential in the depreciation. Okay, and in this calculation, we are going to compare the depreciation between old machine and the new machine. So as in this calculation, alright, the depreciation expense for the old machine, 250,000 minus the salvage value of 0, divide with 10 years of useful life. So the depreciation for the old machine per year is 25,000. And for the new machine, the cost is 950,000 minus with 300,000 of the salvage value times with the useful life of, divide with the 5 years of useful life. So the depreciation is 130,000. And the difference, okay, between the old machine and the new machine is 105,000. Okay, that is the difference between depreciation between old machine and the new machine. And now by using this information, we are going, and the information given to us, we are going to calculate the differential cash flows. Okay, this is the answer for differential cash flows. For differential cash flows, we have 5 years overall in our calculation, and we start with the increase in sales. Okay, increase in sales. So as it is given to us that the sales will be increased by 270,000 for the first 2 years, 290,000 for the third year, and 310,000 for the remaining years. So it will increase by, so this is the differential cash flow. We just look at the increase or decrease of it. All right, increase in sales 270,000 for first and second year, 290,000 for the third year, and the remaining years is 310,000. Another cost that can be saved, all right, by using this new machine is labor cost as well as the defects. All right, and it also has been mentioned to you in the questions that, for example, all right, like this, it will reduce labor cost and cost of defect by 40,000 and by 15,000 respectively. So this 40,000 and 15,000 is the cost that the company can save each year. Okay, so that's why for each year we can calculate for all of this. Nevertheless, the company also will incur this increase in depreciation of 105,000, and this is actually the calculation for the differential of the depreciation that we calculate before, that is 105,000. Okay, so minus with this increase in depreciation, so the total of net saving before tax is this. All right, so you have to add all of this thing minus with the increase in depreciation, so we can get net saving before tax, that is by this figure or this amount. And we also have to consider tax in this, that is 20% out of this net saving. So this is the tax that the company have to pay, and this is the net saving after tax, that is net saving before tax minus with tax. So that's why we can get here 162,800. all right, for the net saving after tax. And after that, in this differential cash flows, we have to add back the depreciation that we deduct before. All right, so depreciation we add back here. All right, so this is the total differential cash flow for year 1, 2, 3, 4, and 5. That is 267,800 for year 1, 267,800 for year 2, 282,600 for year 3, 297,400 for year 4 and year 5. Alright, so as in this differential cash flow, you can see that here we minus with the depreciation, but after that we add back the depreciation. Okay, if you look at this, possibly you think why it is the calculation is like this. We minus with the depreciation, but now we add back with the depreciation. The point is, depreciation, okay, is actually, it is not relevant cost. This is irrelevant cost. Okay, you learned before that this is a relevant and non-relevant information. So all of these are relevant information basically. So however, for depreciation, it is not relevant cost because it is a cost that happened in the past. Unlike the increase in sales or the labor cost or defect, all of these costs will happen in future. Alright, so all of these are the cash flow that will happen in future. So that's why we consider that. But for depreciation, okay, it is basically irrelevant. It is not relevant because it happened in the past and we cannot do anything about it. Nevertheless, why we include this in our calculation is because we want to get the tax saving here. If we minus with the depreciation, we can get a lower tax saving. Okay, we can, I mean that the charge for the tax will be lower, so we can get a tax saving here. That's why the tax saving is relevant information. Okay, is relevant information. So that's why in this calculation, given that the tax saving is important and it is relevant information for the company, therefore we minus with depreciation in order to get the tax saving, and after that we add back the depreciation in our calculation to come up with our differential cash flow. So if, for example, the company didn't, deduct with the depreciation, obviously the tax that the company have to pay, it will be higher, okay, compared to if we deduct with the depreciation. So the tax will be lower. Okay, so next is the terminal cash flow. Once we terminate the project, okay, what kind of cash flow that will happen in the company? That is, number one, we can recapture our working capital back. So because the company have to bond for this cost, the company have to provide it with this working capital investment of 55,000 because they want to cope with the machine. Okay, so once the machine is no longer in use, means that we can get back all of this working capital, and this is by assumption that we can get them all. So the recapture of the working capital, as you can see in the questions, all right, in order to compensate with the increased sales, firm would have to increase its investment in working capital by 55,000. So once we terminate the project, we can get back the working capital of 55,000, and we can sell the machine with the salvage value of 300,000. So this is basically the terminal cash flow. All right, this is the terminal cash flow that we can get at the end of the projects. All right, we revisit the initial outlay calculation, where, as we discussed before, this is the cash outflow from the acquisition of the asset, and this is the cash inflow from the selling of the current machine that we have. So the total cash outflow is 1005000 here, and the total cash inflow is 99100. We add this both. So this is cash outflow and this is the cash inflow. So it seems that the initial outlay is 905,900, where this figure we deduct this and this. All right, so finally we can get here the initial outlay of a negative, of 905,900. Okay, so this is basically the figure that we are going to use once we want to calculate the payback period as well as the NPV. Okay, now we look at the calculation for the payback period. So the net cash flow, we can see here in this column, year net cash flow, and this is the cumulative cash flow. The point of payback period is for us to know how many years that we can cover for our initial outlay costs. So as you can see here, the payback period is, up to, if you look at the year 0, it is where the initial outlay, that is 905,900 from here. Okay, that is the difference between cash inflow and cash outflow and cash inflow. So we can get here the total initial outlay of negative of 905,900. So there's a cash outflow here in year 0, and the cumulative cash outflow is 905,900. In the year 1 and 2, okay, obviously that there is a cash flow of 267,800. all right, and this is from the calculation based on our differential cash flow that we already calculated before. Okay, 267,800 times 2, that is for the year 1 and year 2. Okay, this one, 267,800, this times 2, so the total is 535,600. So in the second year, there's a cash in, because this is the cash out, there's a cash in of 535,600, and the remaining, if we deduct this with this, we can get the remaining of the cash flow is 370,300. okay, in the third year, all right, 282,600 is the cash flow for the third year. We minus this with this, then we can still get the remaining of 877,000. Okay, and we understand that in the year 4 we still can get a cash inflow of 297,400. all right, so it seems that the payback period is somewhere around here, 3 and another whatever years. 3 is the confirmed years and plus, you know, the remaining, because in the third year our initial outlay balance is 877,000, but in the fourth year the net cash flow is 297,400. So it seems that by the fourth year we can already make profit and we can actually settle our initial outlay. Therefore, all right, 3 years, so 3, because we are in the third year at this point of time, plus this one 877,000 divide with 297,400, we can get 3 plus 0.29, which means once we reach 3.29 years, we can already cover for all of the initial outlay of 905,900. Okay, so by the time 3.9 years, we already cover for this cost, and after 3.29 years we actually make profit. Okay, we gain the profit. Alright, now we look at the calculation for net present value. Alright, so in this column, number 1 is about the initial outlay of 905,900. 1, 2, 3, 4, 5, all of these are basically the differential cash flows that we calculated before. If you look at the table of the differential cash flow, all of this figure, what makes difference here is that in the year 5 we will also have the salvage, the where we are going to terminate the project. So this one, the terminal cash flow, that is 355,000. Alright, so by the end of year 5 we can get back this, so that's why we add this here in our NPV calculation. Okay, so NPV, you have to remember that net present value means that all of these future figures we will bring back to the current year. Okay, we will bring back to the present year. Alright, so for the year 0, the initial outlay is 905,900. So obviously this is the base year or the present year. Okay, the present year that we are talking about is 905,900. In the first year, this is the differential cash flows, 267,800. This is the differential cash flow for the second year, third, fourth, fifth. Alright, and we have to times this with the factor, present value interest factor of 12%, because it is given in the question that the cost of capital is 12. And you have to get this factor from the table. That is the table of I will show you later about the table. Okay, table of time value of money table, and the table of the present value interest factor. Okay, and you can get all of this figure from that table based on n. N is number of years, n is 1, n is 2, n is 3, okay, n is 4, n is 5. So by using n and look at the cost of capital figure, you can get this factor at the table. I will show you later. Alright, so once we get this factor times with this net cash flow times with this factor, we can get this. This is the present value. Alright, present value of the cash flows. Okay, because this is actually the future value on the first year, second year, third year, fourth year, and fifth year. Now we bring all of this back to the present value. So the NPV at the end of the day, alright, because this is initial outlay that is negative and all of these are positive, so this initial outlay minus with all of this cash flow, and at the end we can get a positive NPV. Right, the NPV is positive, so it means that the cash flow is higher than the initial outlay. It means that this project is profitable. NPV is actually a very good mechanism to identify whether we want to accept or reject the project. Once we get a positive NPV, absolutely, normally we can, accept that kind of project. So as in this case, it seems that it is quite lucrative. All right, it's quite good. So because NPV is positive, and the positive is not just one, but 307031, so it seems profitable for the company. Alright, I continue with the next question. Using the payback, where the firm's desired payback is 4 years and the NPV criteria, should the old machine replace? Give your reason. So as we can see that the calculation before, the payback period is 3.29. It is lower than the desired. The desired is 4 years. So actually, once we reach 3.29 years, we already can gather or can collect our profits. Right. And the NPV is positive. So this decision is actually very strong in the sense that, yes, once you can see that the payback is below the desired and the NPV is positive, therefore the decision is yes, we have to replace the machine. Alright, the last part is about why, in order to make a long-term decision, organization have to consider the effects of inflation and taxation in capital investment appraisal. So in this sort of questions, you can use your reasonable judgment to come up with the answer basically. In regards to taxation, we have no choice, but if the company cannot run away from tax, it is compulsory for the company to pay tax to the government. So that's why if the tax is low or high, so it is something that need to be considered because it will basically affects the profits. Okay, so both of, like taxation, for example. So if the higher the profits, the higher the tax that the company have to pay, and it sometimes change according to the government regulation or policy. Sometimes if the government is not really making money, they will impose higher tax to the company to earn more money for the budget. Alright, so in regards to the inflation, for example, because it is a long-term projects, and all of these figures are basically estimation. We are not sure if there is another cost that will happen in future because of inflation factor. So that's why in long-term decision, all of these factors also need to be taken into account. And basically, all of these are very much related to the stability of the economy in a country. If the economy is good, if the politics is good, normally all of this will be a bit stable. In terms of inflation and taxation is something that's controllable. Alright, means that it is normally not very, very high. But if the economy is not that good, and the political is not that stable, so normally the policy in regards to the economics also will be affected and might also will give an influence towards the inflation and taxation. So all of these are among the factors need to be considered by the organization once they want to make a capital investment decision. Okay, I show you here the table of the present value, because in NPV you want to bring back the future value to the present value. So now you look at the present value table. Alright, so the period is 1, 2, 3, 4, 5 based on the cash differential cash flow that you receive, and using cost of capital or the RRR of 12%. So this is the factor 0.893, 0.797, 0.712, etc., etc. So all of these figures are the factor that you use in your calculation of NPV.